field of investment banking. With the restructuring of existing investment banks, Blackstone, KKR, and other hedge fund companies will undoubtedly see more opportunities. This largely depends on the regulatory authorities' response to investment banking issues. The scale of the rescue plan is so large, the public response is so strong that the introduction of new regulations is inevitable. However, underestimating the viability of the investment industry is not wise. The last time Wall Street got into trouble was between 2001 and 2003, when the Internet foam burst. U.S. President George Bush promised to end the days of falsifying accounts, concealing the truth, and violating the law. However, in the cowardly solution reached with investment banks in 2003, investment banks were only fined a small amount and made minor changes to relevant regulations, but their business model remained intact. At that time, industry insiders proposed that investment banks were essential for the smooth operation of global capitalism. This time it is difficult for them to raise such arguments again. But the governments of both Britain and the United States are still pro-market, and investment banks, whether as independent entities or part of large financial groups, may receive more humane treatment than appears today. The blow suffered by investment banks in the market not only does not lead to their demise but may even cause investment banks to suffer. The industry has returned to its previous level in the past 10 years in the process of vigorously pursuing principal investment and proprietary trading profits. It has included providing clients with advice on corporate finance and investment affairs. In the bustling bull market, investment banks confuse proprietary business with customer business. As they recover, investment banks may stay away from some. They bring these problems to the deep structured financial products, refocusing on the core business of the past. Although we may have seen the collapse of investment banking, I would be very surprised if we saw the collapse of the entire investment banking industry. The end of the investment banking era. The fifth wave of the subprime mortgage crisis has hit. Does the 8-day period from September 14 to September 21, 2008 mark investment banking the demise of the line? Lehman went bankrupt. Merrill Lynch sold, and Goldman Sachs and Morgan Stanley became regulated banks. This is part of the most disastrous transformation of investment banks since the Glass-Steagall legislation in 1933 created them. In the future, familiar names such as bulk bucket, the label of a large investment bank, an elite investment bank in the United States, will need to be redefined, and year-end rankings will be revamped, while clients and management will need to adapt to new basic rules. However, despite these changes, if investment banks survive the current crisis, they may also exist as familiar faces within the new organization, and the effectiveness of the investment banking industry will also be enhanced. In a sense, there won't be much change. The company we see as an investment bank has become a large gold mine run comprehensive group. After Morgan Stanley merged with consumer finance company Tianhui in 1997, It was no longer an independent investment bank. After Goldman Sachs went public in 1999, it went beyond the scope of investment banking by expanding trading and principal investment activities. By 2007, less than 15% of its earnings before taxes came from investment banking. In fact, pure investment banks have long ceased to exist. Incorporating some well-known old brands into banks and redefining some other brands will hardly affect customer service or market share. As for the performance of investment banks, whether these financial groups align their business with other businesses is just a symbolic issue. However, the market turmoil will bring opportunities for other institutions to enter the investment banking business field. In recent years, the financial services of human capital companies, hedge funds, and investment banks are showing a convergence trend. Goldman Sachs, which has a private equity and hedge fund business, is no more like an investment bank than the acquiring company Blackstone. Blackstone also has consulting experts and alternative investment funds. The ambiguity of these differences has led alternative investment companies into the treating foreign investment as a raging beast will make immeasurable historical mistakes regarding global foreign direct investment (FDI) in 2007. There were serious disagreements in the reports released by the two institutions according to data from the United Nations Conference on Trade and Development. Global FDI reached a record high of $1.5 trillion in 2007, with 2/3 in developed countries and 1/3 in developing countries. The United States led with $193 billion, followed by the UK with $171 billion, and France with $123 billion. China is still the leader in developing countries on the contrary. According to data from consulting firm OCO Global, although global FDI increased in 2007, it was still less than $1 trillion. While China surpassed the United States as the most favored foreign direct investment destination with a $90.4 billion investment attraction. How to interpret two sets of data and two conclusions. In the era of capital factors, the differences in FDI data first reflect the following issues. Firstly, the ranking of investment attraction is based on a manifestation of the country's ability to attract foreign investment and its trends. It is evident that different institutions have different judgments on China's performance in this regard. 2. Looking back, foreign investment has a Matthew effect. Inconsistent compliance add some variables to the choice of foreign investment destinations in the future. 3. The concept of a virtual economy with financial civilization determines its attractiveness and even a country's position in international economic activities. The moment is coming to test the emerging markets and China concept. Secondly, the data fight is related to the new trend of global utilization of foreign investment. International experience shows that utilizing foreign investment, the approach is related to the stage of economic development. In the early stages of Economic development. There are bottlenecks such as production technology, management experience, and overseas markets. And direct investment that solves these difficulties has become the focus of utilizing foreign capital. With the increasing maturity of industry and the expansion of domestic and foreign markets, indirect investment portfolio investment is not subject to direct investment regulations. Future countries will be extremely sensitive to food prices, and control the rise in grain prices will become the focus of policies in various countries. In the short term, international grain prices may rise or fall due to the government's efforts to control the situation by increasing energy market supply and introducing subsidy policies. But food prices have actually embarked on the irreversible path of oil prices, and what countries are doing with oil prices now may follow suit in the future. Oil prices have prompted countries to jointly reflect on energy policies. And future food prices cannot be fixed by a single country adjusting its policies. Multiple leaders have engaged in a food summit, but measures to stabilize food prices in various countries may be resolved through genuine interests. More importantly, unexpected events such as natural and man-made disasters, financial turmoil, etc. will increase the dispersion of future food prices. As for whether international grain prices will rise and fall, whether they will remain at a high level or return to normal, it depends on the combined force of various uncertain factors, especially whether countries can reach a consensus on the issue of grain prices consistent. Nowadays the oil price has not yet unified the front line, and the solution to the food price problem is clearly even more elusive. Therefore, in the long run, both the country and the market will keep up with food prices, and international organizations may play a greater coordinating role. And China has clearly become an oasis in this food price tsunami. The increase in domestic grain prices is relatively flat stable, with an increase of 6.8%, 7.4%, and 11.4% from March to May, respectively, because the self-sufficiency rate of grain in our country is as high as 95%. And the 150 to 200 million tons of grain reserves make the Chinese people have food in their hands and have peace of mind. More importantly, China's grain prices have not yet been liberalized, and the firewall of price controls has isolated the soaring international grain prices. In addition, the government has taken measures such as transferring grain from the north to the south, reducing exports, and raising the minimum purchase price of rice and wheat, so that China has not fallen into the vortex of the international food crisis. But after all, the current prices of rice and wheat in China are only about a quarter and one-third of the international prices, and the gap between domestic and international grain prices is constantly accumulating upward. Why? In order to stabilize food prices since March, China Storage Grain Corporation and COFCO Group have sold wheat and rice in. There is already upward momentum in adjustments, but the qualitative change in food under the impact of civilization has accelerated its recurrence of the oil price mistake. On the one hand, biofuels endow food with energy attributes, exacerbating the contradiction between grain and oil substitution and the competition between people and vehicles for food. 70 liters of biofuel consume a person's annual rations but can only drive a car forward for about 700 kilometers. The World Bank predicts that corn ethanol can save 2% of global oil consumption, but it will cause a 30% increase in food prices. On the other hand, food prices are distorted by the highly financialized capital system. Wall Street speculators have become the world's largest hoarders of food. In 2007, half of the total output value of corn, soybeans, and wheat in the United States was held by buyers of agricultural futures, and agricultural funds exceeded $150 billion. Capital speculation enlarges the imaginative space of grain prices, allowing futures prices to lead the trend of spot prices, and controlling the rise and fall of grain prices is as easy as pie. Grain prices are clearly embedded with unstable genes, and once anomalies accumulate to a certain extent, they will release risks. The release of this crisis reflects the complete ecosystem of economic civilization. The development of industrial economy, financial civilization, and other alienated agricultural food attributes undoubtedly turn to agricultural civilization for strong retaliation against industrial civilization and other civilizations. This kind of backbiting has made grain a strange attractor of instability in the world, even in the United States. There has also been a rice rush in China. In fact, food is becoming a more powerful political weapon than oil, rewriting world politics. Southeast Asia, used to be the world's granary, however, has weak disaster resistance and high fertility rates. Agriculture is mainly focused on labor-intensive crops, while ideas remain stuck in the agricultural era, and its vulnerability has been exposed in the rice crisis. The United States, on the other hand, is uniquely endowed with not only 13.15% of the world's arable land, forming a large-scale agriculture with large-scale planting and industrial management, but also the ability to turn the tables in the financial market and seize the commanding heights of genetically modified crops in agricultural technology. This gives the United States both capital and strength to wield food weapons. The corn ethanol strategy implies an international strategy. On the one hand, the United States consumes excess corn under agricultural self-sufficiency and monopolizes the pricing, financing costs, acquire and restructure industries, and strengthen operations to obtain rich profits. But in China, after a round of bull market noise and madness, PE has almost become an equity speculator. Generally, in the pre-IPO non-listed equity investment stage, it only takes 2 months to achieve over 100% net income. Therefore, as a synonym for money-making tool, like the portal websites that were established by both cats and dogs back then, both investment banking, consulting, and investment professionals rushed into this industry for a while, establishing to attract investors. However, the dot-com bubble has burst and closed its position. The bull market feast will also end, and a large number of low-end, concept-only Chinese PE will also be evaporated. The relevant policies have only accelerated this process. Secondly, the misaligned timing of life has caused PE to turn from bull to bear before it has fully unfolded. Funding for VC and PE in mature countries, many of them come from professional investment institutions such as pension funds and education funds, as well as mature wealthy individuals. These NDS do not require short-term returns, but focus on long-term growth. Therefore, PE funds are truly idle and can be locked in for more than 7 years. In China, however, the capital client requires PE to move in and out as fast as the secondary market, to exit in 1 or 2 years. And to have returns beyond the industry. But what else can't they ask? It is precisely this cognitive mismatch in time and space that has led most local VDS and PES to focus on investing in late-stage projects such as pre-IPO, falling into a vicious cycle of being too eager for quick success and instant benefits. Therefore, although the average size of domestic funds is still less than 1/5 of that of foreign funds, the projects covered are particularly large, not yet enough. But with the decline in the stock market since the second half of last year and the uncertainty of the exit channel, PE, the valuation of investments, is rapidly decreasing. So, should companies still entrust money to PE? What is the prospect of PE investment? Actually, this requires we need to interpret it from a larger perspective, as PE is a typical representative of financial capital generated at a certain stage of economic and social development. Its fate is closely related to another major capital driving economic development, industrial capital. In essence, financial capital and industrial capital are simply intercepting different parts of the same interest chain, but they always try to nibble at each other's interest segments, forming a game on the one hand. In the view of